Hello everyone and welcome to Fintelligent Investor series by Rupai Financial Services. I'm CA Pratiksha Pai.
And I'm CA Sanket Naik.
Happy and then better. There. Mother. And then. After that. It's a time. Get the bus.
So this is our 15 into 5 is equal to 75 series, wherein starting from 15th August for 5 days, we take 5 topics of interest and speak about 15 basic important points about each of these topics. So 15 into 5 is equal to 75, and this is how we are celebrating the 75th Independence Day.
Please. Like. Share. Share.
So there's a karate competition. Why don't you join it?
Karate. I don't even know anything of karate. How should I go to a karate competition?
We can watch on YouTube. We can listen to some of our friends who know it. And I think you'll win the competition.
By just seeing YouTube and listening to tips from friends, you think I'll win the competition?
Well, that's what people are expecting when it comes to stock market, right?
So yes, it's right. No, when it comes to share market stuff, people want to listen to TV, YouTube, friends, relatives, and then start investing in some shares just because of the tips that they got, right? And do you think it really works? I'm not sure. So we thought we should do this video on basic important points about share market. So it is very basic points, basic 15 points which any beginner should know before going into share market. You can't go for a competition without knowing anything about it, and share market is not a competition, right? It's like a war. So you need to know few basic things, and of course it's better if you know advanced things, but these few basic things you should and must know. So let's start this video on basics of share markets.
So Pratiksha, can you let us know what is a share?
Yeah, when we are talking about share market, let us start from the basics, right? What is a share? So now, see, if you go to eat pizza, okay, that big pizza with 8 pieces. So sometimes, at least I cannot eat the whole pizza, can we? No. But if we are with 8 friends, 7 friends plus us 8, of course, if we are 8 people, each one of us can take a piece and eat, right? So that one piece of pizza that you have, that is your share of the pizza. Okay, so a share is nothing but a share in something, a share of something. So see, we see there are huge companies in India today, billion-dollar companies, and we see really huge companies that have grown in such a small span of time. But is it possible for everyone to own that company? Yes and no. You can't own the whole of that company, but you can own a part of it. Okay, you can own a part of that company. And when you purchase a part of that company, that is called a share. And you are a shareholder, and you have a share in the ownership of the business of that company. So what does this mean? You are an owner of that much portion of what you have paid. You can't always pay billion dollars and purchase, but you get shares at very reasonable rates. You can purchase even one share, which is a minuscule portion of the business of that company. Okay, and what happens when these companies are earning profits? You also stand a ownership right to get those profits, get that part of profit which belongs to you. So this is a share is a portion of a business that you're owning. So now we know what are shares, so now we can move on to knowing what is a share market. So Sanket, can you tell us what is a share market?
Yes, definitely. So share market, in very simplistic terms, it is a place where shares are bought and sold. But what do these shares represent? At the end of the day, shares represent businesses. So how you can put it in layman terms is that you are buying a piece of business or selling a piece of business. And can we do this with any business? No, there are certain norms which you need to fulfill. Listed companies are the ones where you can buy or sell them. Just a regular company also won't do. It should be a listed company. So what is a listed company? See, there are companies who list their businesses on the stock market. Such companies are ones where you can buy or sell their shares. So this is exactly what happens in the stock market. You buy and sell shares of such businesses which are already listed. in the stock market. So now that we know what a share market is, so some of the most popular terms we get to hear is BSE and NSE. So can you let us know what is this BSE and NSE?
Okay, first things first, BSE stands for Bombay Stock Exchange and NSE stands for National Stock Exchange. So, what does this mean? What is a stock exchange? So, we know now what is a share market. Stock exchanges are a platform that facilitate the trading of shares, the purchase and sale. Okay, so now see, you can say that there is a garment market or say there is a flower market, but there are vendors, right? There are shops in which you get, it's not like you go to the market and everywhere there is flowers and you can do whatever. There are shops, you go to a rose shop, you go to like that. These are stock exchanges, are basic platforms which facilitate the trading of shares. Okay, that may be either sale or purchase. So the companies are, they have to list themselves on BSE or NSE or both, right? And that's what, once they get listed on these stock exchanges, the trading of these shares is facilitated on these stock exchanges. When we are talking about BSE and NSE, then there are two closest terms that we always listen in relation to these. What is those two terms? Sensex and Nifty. We almost hear it on a daily basis. So Sanket, can you tell us what is Sensex and Nifty?
Yes, definitely. Basically, they are indexes, but let me elaborate. So, Sensex is the benchmark index of the Bombay Stock Exchange. It represents the top 30 companies of the Bombay Stock Exchange, and this could be from any sector for that matter. Similarly, Nifty is the benchmark index of the National Stock Exchange. It represents the top 50 companies which are listed on the National Stock Exchange, and again, they also could be in relation to any sector. So, Pratiksha, can you tell us what these indices represent?
So when you purchase a book, it has an index, right, at the beginning. So what does that index represent? So what is the content you'll find in the book, correct? So in the similar fashion, what does Sensex and Nifty indicate? As he said, Sensex has the top 30 outperforming companies in that are listed on BSE, and Nifty has the top 50 outperforming companies of the NSE. So one of the most important things that these indices indicate is the way in which our country's economy is going. Okay, this is one of there are many other things also, but this is, when you look at the Sensex and Nifty, you can generally tell that when you look at the Sensex and Nifty, you can generally tell that the market direction is this. Okay, so it's one of the basic thing it represents is the economy of the nation, but that is not the only indicator for the economy, how the economy is going, because there are many unlisted companies in the not very regulated sectors, and these also may be, this definitely contribute a lot to the economy. But these two indexes also are a major indicating factor of how the economy is going. So when we come to this, we saw that the companies in Sensex and Nifty hold a great value. Okay, are these companies fixed in Nifty and Sensex?
No, they are not fixed. What happens is, over a period of time, the companies which are underperforming can be replaced with other companies which are performing better. Though most of this happens with few companies. It is not that the entire index gets changed at once, but most of the shares remain the same, but there are changes which keep happening. So there is no fixed time period as such, but it can happen at regulated intervals.
Also, what these companies represent and why these are put in that index is because, when the market increases, these companies will suddenly increase, whereas the rest of the companies may take a little while. When the market falls, say Sensex and Nifty falls by say 5%, the companies outside which are not as good as these may fall 15-20%, and again when the market is rising, these companies will just bounce back, and whereas the other companies may take a longer time to bounce back. So yes, these are all the best companies within those stock exchange that are grouped, right?
Definitely. At the end of the day, everyone is here in the share market to make money. So realistically, what are the chances of financial growth in the share market?
So it is really possible to do good financial growth trajectory in the share market, because now see, if you're a long-term investor, the value of the shares that you invest in, if you invested in good shares, there will be a capital appreciation. Okay, and I'm talking about all the outperforming companies. Generally, if you have invested in the companies that are listed in Sensex and Nifty, there'll be a good capital appreciation, and also the dividends that you get. The good companies which are really making profits, there's not only capital appreciation, but every year they give you dividends. What is a dividend? It's just that part of the profit which they are giving among the shareholders, okay, which they are distributing among the shareholders. So that dividend is also, and one really very amazing thing is that there are many people who can live off the dividends. Their entire expenses they can cover in their dividends, because some person maybe in the past has done a really good share investments. Right. So they have a good capital appreciation also, and they get great dividends also. So these are two for the long term investors, and those who are even doing daily trading, okay, they too can get all the daily trading profits if they trade with caution and with knowledge. Okay, because this is not a gambling den. So if they have the requisite knowledge and the requisite patience, so and then they can definitely do daily trading profits as well. So yes, it is definitely possible to have a financial growth in the share market. And definitely, I would say that if someone's young and being able to take a bit of risk, then definitely share market is much more higher than FDs. Correct? Don't you agree with that?
Definitely, because the rate of return you can get it on even a daily basis what you would earn in a year as well.
Yes, when you are putting it in share markets. Also, the thing is, why I said Sensex and Nifty, when you when you invest in these companies, I'm not telling FDs are good or bad, but these companies help you to stay on par with the ongoing inflation. Okay, that's the only thing. I'm not telling that there the interest is less or whatever, but these companies will really help you stay on par with the prevalent inflation. So that's a really good way of investing your money. But of course, you cannot invest everything in one place. That there will be I think we should do a different video for that. Investments is a mixed basket. Okay, it just can't be all roses. There need to be all kind of flowers in a bouquet, right? So investment is also like that. But definitely, share market is one of the great ways to invest your money and to stay on par with inflation. Your money grows along with inflation, and it grows at a much faster rate. Basically, you get dividends. If you're doing daily trading, you also get profits with the right kind of knowledge and patience. So Sanket, we talked about having dividends from shares. What are the tax implications of these dividends? Are they tax free?
No, dividends are not tax free. The person who receives the dividend is liable to pay taxes on them. In the past, maybe a few years back, it used to be exempt. The reason being that the companies are supposed to pay an additional DDT, dividend distribution tax, and hence it used to be tax free in the hands of investor. But DDT is now abolished. Hence, whatever dividends distributed by companies are taxable in the hands of the shareholders. So, how can you purchase shares in the share market?
So to purchase shares in the share market, there is either a primary market or a secondary market. So now if I leave it at this, what's the point of this video, right? We want to make this to make it simple for everyone. So yes, what is the primary market? Primary market is where there is IPO and FPO that is coming directly from the promoter. Okay, and secondary market is where you are purchasing shares directly from the share market, traded on the exchange. So that is secondary market, where someone has purchased it from the promoter and then it is now trading on the share market. So that is secondary market. Primary is where it includes IPO and FPO, and that means that you are purchasing shares directly from the promoter himself or herself.
Yes, so promoter can sell their stake, or the company may also raise additional money also through an IPO or an FPO.
Yes,
those
so
are-
that's included in primary market, not only from promoter but promoter or the company issuing fresh shares.
So now that you have mentioned IPO and FPO, could you just elaborate what exactly is an IPO and what is an FPO?
Yes, so when we talked about primary market, I told that there is something called IPO and FPO, and which the primary market, which means that purchasing shares directly from the promoter or when company is issuing fresh shares. So what is IPO and FPO? IPO stands for initial public offer. Okay, here what happens is the company comes up with the IPO saying that we need funds either to pay off our debts or to expand our businesses. There is a demand and we don't have funds to expand and we want funds, and with that we are willing to give you all a share in the ownership of the business. So what the company does, initial public offering, that means they are coming onto the share market, they are coming on the stock exchange and they are getting themselves listed, and they are telling that yes, we are ready to give away so much percentage of shares to the public. Initial public offering. Okay, so they are telling that all of you can subscribe and come and join us. Okay, so here what happens, let me tell you. Now see, if there is a building being constructed, okay, like we have our office here, like that some commercial building is being constructed, and what the builder has to do at the beginning, once he has finished construction and all, and now he wants to sell, he has to do marketing because nobody knows him. He has to say that I will sell. He has to put in efforts and expense and tell that okay, I am going to sell so many units in this building. Okay, and then people will come, they will buy. Say there are 100 units, he will tell that right now I will sell you 20 units. Okay, 80 right now, it is not ready for sale, 20 is ready, I will give it to you. So people, they don't know the builder, so he will do marketing. He will tell there is this facility, that facility, please come and take. And then finally people will tell okay, 10 will come, 20 will come, 30 will come. Then they will do a lottery, and whoever wins the lottery, they will get the units. Like that building will come, and then the 20 unit holders who have taken those 20 units, maybe they will sell after some time, others will purchase, and this will keep on happening. After some years, the builder will tell that I want to sell 30 more units. By now the people know the building, the people know the builder, they know that wow, it is right on the in very heart of the city, in the business center of the city, we can put our office over here. So people know and people want a unit in that building. So when the builder says that I am going to sell more, what will happen? Immediately there will be a rush of people to purchase the units. The builder doesn't have to tell much. Okay, so the people will come and they will tell that yes, we want to purchase. Okay, so what is happening here? Are people purchasing it second hand from someone else? No, people are purchasing from builder itself. But when he initially offered the 20 units for sale, that is something like IPO. People don't know the company. They may have heard of it, they may have heard, it may be rumor, it may be true, whatever. People don't know how it will perform. Okay, but still people will apply. But now the company has been on stock exchange, people know how it is performing, and then what will happen? The company will issue either fresh shares, or the promoter will come up and tell that we are doing an FPO, that is follow on public offer, that we are willing to give you more shares for your ownership. So by this time people know how the company is, and if it is a good company, people will go and purchase. The promoter or the company does not have to incur that much of expense like IPO, because people already know it is already doing good on the stock market. Like for example, TCS had come up with the FPO. So when it is an FPO, it is a primary market itself, but the people know the company better, the people know its performance better. And that's the difference between IPO and FPO. IPO is when the company comes first and tells and lists itself and tells that it's going to issue shares, and FPO is when after a while again the company comes back and says that we are going to issue you more shares. So that is IPO and FPO. So can we, when we talk about share markets, always, we also hear the term called Demat. So what is this Demat account that people keep talking about?
Yes, so Before Demat came into place, earlier shares used to be issued in a physical form. There used to be something called a share certificate. And what used to happen is, if you wanted to transfer a share, you had to send a share certificate to the registrar for a transfer. It used to take days and weeks together for the whole process to be completed. In addition, as well, what used to happen is, if there was a loss of certificate or damage in certificate, you could sometimes lose the value of your shares altogether. Now Demat came into place. What used to happen is, all these physical certificates were dematerialized and put in an account, and this is what a Demat account was. So whatever your shares which you are holding will be shown in the Demat account, and similar to your bank balance, there will be a Demat balance which you'll be having.
So it's like how initially, when the civilization started, there was a barter system, then it came to cash, then it came to online banking. So now nobody carries cash. And then again, when there was jewelry, there was gold and all. But now from physical gold, we are transiting to online gold. We have made a video on that also, on sovereign gold bonds. So I'll also put the link to that video as well. And like that, everything is going into online format, right? But it's really good.
Yes, because see what happens is, it is very easy to transfer because of this, right? Because you have a Demat account, it just takes a few seconds, a few minutes to transfer something. Unlike in the past where you had to do it for weeks together and face several issues like signature mismatch and whatnot, loss of certificate. Lot of these issues used to be there.
Also, when shares come through inheritance and all, whether if there is Demat, it is more easier, no?
Yes, because many of the times what happens is, someone could have bought the certificate and misplaced it, or
And not inform the family about it.
you would have no ideas. We have heard a caller at one point of time who had just called a stock market channel, and he was asking him about, I have some share certificates.
True.
And what is the value of this? He had no ideas, and that's what can happen. So a Demat account, it makes it very simple, wherein you know it, you can specify who your nominee is, and in case of an unfortunate event like death, your nominee can come into place and you can easily get the shares there.
True. And also what happens here is that when there are share certificate also, sometimes, the writings may have, erased, and, in other cases, people don't even know. There could be, it could get damaged and people won't even know it's a share certificate.
Definitely,
So,
there are defaced share certificates, damaged share certificate. It could be spoiled, it could have got wet due to rain, whatnot. It could be hundreds of reasons. So
and I also think that anyone who has yet not dematerialized, which could be a very small percentage, but still, I think they should go and dematerialize their accounts, right?
yes, definitely.
Especially the older generation who may have so many share certificates.
Yes, definitely. Though they may be good to look at, but at the end of the day, I mean, it's very difficult to do anything with these certificates. Now, when you make it into Demat form, everything becomes simpler. Even your dividends, they directly come into your bank account. Otherwise, you get a physical
Dividend warrant. Yeah.
And what happens, many of the times, the warrants are of very small value. If you want a negligible shareholding, there will be a 1 rupee warrant which comes, which you may not even want to go to the bank and deposit. Whereas when you do it as a Demat, everything gets credited to your bank account. You just have to mention your bank account details there. And even if there's a change in bank account, it becomes very simple. You just have to update the Demat account and everything gets automatically updated there. Otherwise, you have to notify each and every company and all these things. It was a very big hassle.
So how do you open this Demat account?
So there are multiple DPs, depository participants. So now, and there are stockbrokers. Initially there were different independent functions, but nowadays both of them are being followed by the same persons. So what happens is, you can open an account with them, and based on that you can buy and sell your shares, and you can even apply for IPOs. Even for these you need a Demat account.
And also, of all the transactions that you have done, you get the whole statement in the Demat account itself. So you don't have to keep a separate note of it and all. Everything is already there. It's just like a bank account, right?
Yes, definitely. You will get everything in one place, in one statement. You will get to know everything.
The purchase, sale value.
Correct. There is no question of physical damage of certificate, or there is no hassle in transferring a share, all these things are very simple because of Demat accounts.
Also, in case there are trading profits and all later on to do the tax calculations and all, this is really helpful, right?
Yeah, I mean, nowadays stockbrokers give readily available statements as well, wherein you get a lot of these data at one shot. Otherwise, in the past, you had to take out the contract notes, the old contract notes, and calculate the taxation. But nowadays, everything is majorly available in one place. You can easily get it at one shot.
So it's a very important, right? Demat account. Even if you have zero knowledge, that is the first thing you should be having if you are entering the share market, no?
Yes, and Demat is not only for the share market. Demat, like she said, it is even for bonds, even for sovereign gold bonds, or it could be even nowadays they have come up with the concept of e-insurance as well, which can be done. So considering all these things, Demat is the way to go forward.
So Demat account can be opened from what age?
See, ideally a Demat account can be opened at any age. Normally, majors is the usual concept that someone should be above 18, but it is also possible for minors to do it as well. It's only that minors are not in a position to do trading. Because they are not in a position to enter into a contract legally, so they are unable to trade, but at the same time they can inherit shares. So parents, grandparents or any other relatives can gift shares to a minor. There are other transactions which can happen. So even a minor can have a Demat account.
But only with the investment purpose, kind of. They
Correct.
can't go and sell those shares.
That's right.
Okay.
So you mentioned one of the options is trading in the share market. So what are there different trading styles?
Yes. When you're in the share market, see, people feel that share market is a really good secondary source of income because you can start earning from day one. Okay, you don't have to do any marketing, you don't have to incur any expenses like an office space. You just, even with a simple smartphone with a good internet connection, you can start earning from day one, okay, from the share market. That is why people sometimes term it as a secondary business, a secondary source of income. Okay, so there are various trading styles in share market. First one is intraday trading, which, when the share market opens in the morning, you start trading. It can be either purchase or sale, and by the time the share market closes, you square off all the positions and come out of it with a profit. Okay, this may not always be profit, but if you have the right knowledge and the right patience, definitely it may be a profit. But realistically and normally, this is a very small profit. Okay, it's not a very huge profit generally, realistically, I'm telling. Then second is where you purchase a share and you hold it for 5 to 6 days. Okay, 5 to 6 market days. Okay, and then you see at what point of time it gets a good value and then you dispose it off. That is called a swing trading. Okay, which is more than intraday trading, but just say, let's say, a maximum of 10 days. Okay, not much. You are not intending to hold on to that share, you're just waiting for the right moment to get it to certain level and maybe get some 5 to 6% of profit. Okay, and then the third one is short term trading, wherein you purchase a share and you hold it for like 2 to 3 months. Okay, and after 2 to 3 months you see that when it's getting a good traction and a good value, you sell it off. Okay, and the fourth is long term investment. I won't call it long term trading because it is long term. Say you're holding a share for more than 3 years. Okay, so then it becomes a long term investment wherein you are holding the share to gain either dividends or capital appreciation. You know that the share will go higher and higher in future, so you have a investment which, instead of putting in other FDs or something, you are putting it in the share market and holding on to it. So these are the four kind of share market trading styles generally, and four of them also have their own pros and cons. And I think the older generation, I think they had the mentality of long term investments more. Take a share and hold on to it, and it will get capital appreciation and dividends, and maybe it can also be inherited by the youngsters in the family and all. Youngsters generally have more of a risk appetite, and also I guess more of a stress appetite, I don't know, but they generally may prefer intraday trading and making a quick buck, as they say, making quick money, because generally in intraday trading, if someone is really realistic and practical, they can aim to get at least 1% of the profit of the amount that they're trading in. So what I mean to say is, if someone is trading in just 10,000 rupees, they can at least make 100 rupees and come out in a day. Okay, if someone is trading in 1 lakh, they can at least make 1,000 rupees and come out, and people are happy with that profit because it's quick money. Who will give you 1% in a day? So in that way, in a few hours in which the market is open. So that is the beauty of intraday trading and the beauty of long term investment. Like you told, someone called a news channel and told that I found share certificates of my grandfather and the value was into multiple crores. So that is the beauty of long term investment.
Many of the times we hear the terms bullish and bearish in relation to the market. So, can you let us know what they mean?
Yes. So, first of all, bull and bear are so improbable terms, right? Why didn't they keep lion, elephant? I mean, elephant is so strong, fox, they could have kept that, right? Lion, tiger. But the specific terms that have been introduced in the share market, especially, are bull and bear. And we can also, in that Wall Street, we can also see that bull just standing like that, okay? And, generally the sentiment of the market, when you say bullish, they're happy. When you say bearish, certain section is happy, maybe, who are the bearish contenders, and generally the market seems dull in the bearish. So what is this bullish and bearish? Okay, so first of all, let us see what is a bullish market. So if you see the qualities in the bull, okay, when the bull is angry or charged, let me say, okay, the word is charged. When the bull is charged and a victim comes in front of the bull, what it does is it propels the victim with its horns, okay? So it's not like a slow movement, it just propels, it just throws it high, okay? So that is the same thing that happens in a bullish market. Suddenly there is a high. That is when there is it's called a bullish. Suddenly all the shares, almost the entire market is green, okay, showing a high. So everything is going up, okay, and it's a happy moment for all the investors, and that is why it's called a bullish market, okay. Whereas what happens with the bear? When the bear wants to attack someone, it just doesn't go and attack it. It plays with its victim. It makes it roll on the ground. It kind of tickles the victim and all that, and it is a slow process, okay. So the the victim doesn't even know that it is the victim, okay. It's just playing with the bear. So when it's a bearish market, the stocks are falling slow, they're falling. The shareholder is not really, he can't tell surely whether this will fall and should I now exit or should I hold on, or how it is. It is falling. So that is why it is called the bearish market. And the bear also puts its victim down, okay. The second thing, it puts its victim down. So that is why it is called the bearish market when the markets are going down. And when the markets are going up, it is called the bullish market, because the bull propels its victim into the air, okay, and the bear pushes its victim down, okay. So that is the reason why these two animals have been selected very aptly okay, very aptly for determining a rising market and a falling market. So when the market is rising, it is called bullish, and when the market is falling, it is called bearish. So we are on to our 15th point now, and this, I think, should be some interesting question, no? So let me ask you, what are the educational qualifications in order to enter the share market?
Frankly speaking, there is no educational qualification prescribed. Anyone can actually get into the stock market. It is, at the end of the day, in sometimes it can be termed as common sense as well, but sometimes you would need to have some financial knowledge to understand a few things. Some people may get very lucky, but whether you'll be able to consistently do it or not, that is something which you need to keep in mind. But even if you're not from a finance background, it is very much possible for you to understand a few basic things, and based on that, get into the share market and do transactions. So educational qualifications, it's not that someone who is a very highly qualified person in finance or something is the only person who can deal. In fact, there are a lot of people who are laymen who have done much more better than maybe qualified professionals as well.
In fact, there was this article about some 85-year-old granny who started trading in share markets, and she made a really good profit. And there are also articles of 14-15-year-old kids using their parents' Demat account as actually, and trading and making a lot of money for their parents.
So yes, so anything is possible, but it's just that it is better if you get more financial knowledge so that you can understand a lot of these things, and it doesn't just become just a pure stroke of luck. More than that,
Informed luck.
correct. Informed decision making is
Yes.
what you can do, and there are multiple strategies like you mentioned, and usually in the long term, people do tend to earn money in the stock market.
Yes, generally once you have purchased the share, generally in certain case definitely it will fall also, but in majority of shares, if you have selected shares of good companies, okay, then even if you don't trade and just keep it as an investment also, it provides good returns. And sometimes over the years the dividend that you get itself would be more than the initial investment that you have put out. So even other than the capital appreciation, just the dividend itself may also cover your investment. So yes, it is a good form of investment, but you have to take an informed decision. So this was our 15-point series on share market, the very basics of share market, and we have tried to cover those terms and points which are generally used, but sometimes people may be confused or unaware about what it means. So this video was really basic level for any layman who wants to get into the share market. To understand, they should first, it's really good if they first see this video, because the topics that we have covered are really very basic. But if you want more videos on share market, please let us know. We will definitely be happy to have in-depth discussions on each terms, on because there are, in addition to all this let me know, let me tell you, this is really basic. There is fundamental analysis, there is technical analysis to do before you try to get into share market and buy a share. You have to know the fundamental strong points, and how to technically evaluate a share, and all of this. There are futures, there are options, there is so much more in the share market. But this was just a start, I believe. It's just like a kickstart, just telling all the little this thing. And if it has also ignited a spark, then we will be really happy to go a long way into this. Please let us know if you have any confusions, if you want to know more, if you want to know specifically any terms in relation to share market, and we'll be happy to make videos on the same. So thank you everyone.
Thank you.